Forex Trading 101. Foreign currency exchange is basically what Forex stands for, the foreign currency exchange market. We take the FOR in foreign and we get FOR, put that together with the EX of exchange. Of course, we leave out the currency part and put it together to get Forex. So that's how we call it Forex. That's how we get the name. Let's cover a few quick definitions really quick. First, let's cover base currency. What does that mean? Base currency is the first currency in a currency pair, and the currency that remains constant always when determining a currency pair's price. It's based off of that currency pair. That's why it's called the base currency. Knowing the base currency is important as it determines the value of currencies in the exchange when a foreign exchange deal is done. The difference between the bid and the ask. What is that? Bid is selling, ask is buying. So bidding is saying, any bidders? Because I'm selling. The ask is saying, hey, I want to buy. I'm asking you for a price. Would you give me a price? Now, the difference between these two prices is called your spread. The narrower the spread, this normally signifies more liquidity, which brings to us the spread. What is that again? That is the difference between the bid and the ask. There'll always be a spread price. And this is consistent with anything that we trade. The selling price and the buying prices are never the same because this is where the broker gets their money from those transactions. Long. We buy things when we're going long. Long is a word used to say I'm buying. Short means I'm selling. Now, this is a concept that most people have trouble with sometimes. For example, long, nobody has a problem with that. Buying, okay, I'm going to buy it, and I want the price to go up, and so that I can make money. Short is selling something that you don't necessarily have. Now, you can short the market, meaning that I want to sell something, but I don't own it yet, but I want to sell it. So the best example I can give you of a short sell, it would be, for example, let's say that I have some radios, and you have some people who want to buy these radios. Okay. Well, what I'm doing, what short selling would be like is saying, well, okay, you know the people that want to buy these radios, and I have the radios. But you would sell it to that person, even though you don't have the radios, but I do. So you sell them the radios, and then you can, at the time that you make your profit is when you give me the money. So in other words, you made a deal to sell a radio with Johnny for $100, knowing that when you came to buy it from me to give to Johnny, I was only going to sell it to you for $75. You made a $25 profit. So when we put this into the market's perspective, what we're doing is we're saying, okay, you need some people to sell because the market is working its way down. We need sellers in the market. Okay, I'll sell. But after it reaches a certain point, say I jumped into short sell at, say, 100. By the time the price falls to 90, I'm going to buy it back from you at 90. I sold it at 100. I bought it back, that's called covering the short at 90, so I made $10. Because the difference between what you sell and buy something always remains constant, regardless of whether you're long or short. If you sell something at 100 that you buy at 90, you made $10, no matter how you do it, whether you reverse the process or not. So that's the concept in selling short. PIP, or a tick. PIP stands for price interest point. This is exclusive to the foreign currency exchange market because we're dealing with currency. It represents the smallest increment, move, or an exchange rate can make, basically. For example, normally one of these pip points is 1/100th of a penny. mainly in the case of things like the euro or to the dollar, or the pound to the dollar, or the euro to the franc, it'll be 1/100th of a penny, or 0.0001. In the case of something that's based with the Japanese yen, it's still 1/100th of a penny, but because it's the yen, which is 1 penny in and of itself, the decimal point would be 0.01 as opposed to 4 decimal points. Still 1/100th of a penny. It just looks different. Okay? We'll see that as we go on. Margin. Nothing more than the funds that a customer must deposit on collateral to cover any potential losses from adverse movements in price. Basically saying, if you're going to put in a trade for a euro dollar, you need to have a certain amount of money in your account. That's your margin. Leverage is a degree to which an investor or a business is utilized borrowed money. When we trade, many times to create leverage, to create more potential for income, we will leverage the money we have with borrowed money from the broker, pretty much, is basically what it's saying. Liquidity is the ability of the market to accept large transactions. How much money is available to cover the leverage and the margin. Okay. Also, liquidity is also dealing not just with the broker, but with the market itself. The more activity, the more flow of money that's going on with the market, the quicker and the easier, the more tight the spreads are, and the easier and quicker it is to have the orders filled. If you have low liquidity, of poor liquidity, you might put in an order, but it won't fill it because no one else is there to on the other side of the transaction, because there's just not enough liquidity or activity or money flow. Premium, cost of carry. This is basically saying the cost or benefit associated with carrying an open position on a currency from one day to the next. It's calculated by using the differential in short-term interest rates between the two currencies and the currency pair that you're holding. So you have to remember, in the currency exchange market, we're not buying ownership, we're buying the privilege to value. So if you're holding a currency at the end of the day and it pays a certain interest rate, okay, that's positive, you'll get a little extra money for holding it. On the other hand, based on your position, you could be looking to pay interest. So they'll deduct that interest rate from your account because you're holding it. So because you're the one with the right to privilege, and sometimes the privilege is a disadvantage because you have to pay interest. So that's something to watch out for. It's not an awful lot, but when you start trading large amounts of money, it can turn into a decent amount of money that you don't want to have to pay. PL simply stands for profit loss. You'll also see RW sometimes, which stands for risk reward, but this is just an abbreviation. EOD, another abbreviation saying end of day, signifying the end of a day or session. Bullish simply says the prices are rising, or bullishness. Bearish or bearishness, saying that prices are falling. Consolidation is saying that we have neither bullishness or bearishness. Pretty much, it's like going nowhere, just sideways, moving across to the side, up and down, in between a range of price. This is called consolidation. Here are a few currency slangs. Aussie, for example, is the Australian dollar. Kiwi is reference to the New Zealand dollar. Cable, you'll hear people refer to the British pound and call it the cable from time to time, or just pound. The CAD is what they call the Canadian dollar. From time to time you'll hear that. It's just a quick slang so that you don't have to say Canadian dollar. You just say the CAD, and it's a lot quicker and easier. Greenback is the US dollar. When we're trading the Forex market, we're exchanging one currency against another. And basically this is just an example of a few of them, such as GBP stands for the Great Britain pound. So that's the representative of the pound. We have that up here in the top left-hand corner. As you can see right here, the Great Britain pound, and this JPY stands for Japanese yen. EUR stands for euro. Again, there's the Japanese yen. NZD, the New Zealand dollar. The US dollar. The Australian dollar. There's the CAD. Now you see why they call it the CAD. The Canadian dollar. Okay. CHF is referring to the franc. This is the Swiss franc. CHF. Okay. Those are just some of the currencies that you see. And we are trading these currencies against the other. Here is an example with the British pound to the yen is saying this is the base currency. The GBP, Great Britain pound, is the base currency. So what this is saying is if you're selling the pound to the yen, it's going to take 239.22 yen to equal 1 pound, because the pound is the base currency by which everything is covering on this particular pair. Let's go to the euro real quick, because we've got two instances of them here. Here in the euro yen, and then over here we see the euro against the Canadian dollar. So this is saying it takes 163.42 yen to equal a euro. And at the same time, it would take $1.50.66 of Canadian dollars to equal 1 euro dollar. Over here with the Australian dollar to the yen, it takes 99.8 yen to equal 1 Australian dollar. It takes 91.36. I'm sorry, not 0.9136, 91.36 cents of Canadian money to equal 1 Australian dollar. It takes roughly 73 cents and 3/4, 0.7375 US dollars would equal 1 New Zealand dollar. I think you get the picture, hopefully. If not, just rewind a little bit and watch it again. Watch this portion one more time. You'll get it. It's not very difficult. And once again, we'll go into the next frame to cover this base and this spread a little bit more in detail. Here we see the Kiwi versus the greenback, the New Zealand dollar to the US dollar. The Kiwi, or the New Zealand dollar, is our base currency. So everything is based from here, meaning that this is saying we have to have a bid and an ask where it takes 73 and 75/100th of a cent to sell US dollars to get 1 New Zealand dollar. And in buying, it's 73 and 79/100th of a cent of US dollars to buy 1 Kiwi dollar. Okay? How much does it cost? Well, you can start a Forex trading account with a many brokers will let you trade or get started with as little as $300. The only thing is, if you do it with an account that small, you have to make sure your trade size of lots that you trade are small as well. For example, here, you see on this left side, you see where it says trade size. And the trade size is referring to how large of a lot of currency you're purchasing the privilege to. So, with an account as small as $300, you would not want to trade a lot that's so large that it will wipe your account out with a single blow. You have to maintain your money management, 3% risk maximum of your account balance. So if you have $300, your maximum risk is roughly $9. So, with that in mind, you want to trade with a $1,000 trade size. Let's take a closer look at this. Now, let's start with this British pound to the dollar. It's saying that at this particular time that this chart was made, it would take $1.99.015 of US dollars to equal a British pound. And with a trade size of $1,000 lots, that's what you would be trading per contract, would return to you 10 cents per pip. If you were doing this with a $10,000 lot, it would cost you $1 per pip. Every time it moved, increment one time from 199.01 to 199.02, that's $1 or 10 cents with a smaller trade size. As you can see, if you are risking 50 pips, here you're risking $50 out of your $300 account, which is way too much. But if you had a $1,000 lot that you were trading, it's only 10 cents, meaning you've only risked $5. Okay? This way you are able to trade within the proper money management that is required to do good trading. Now, let's move on and take a look at some other things. Just a little closer here, we see the same thing here. This is the trading the $1,000 lot size, your trade size. Okay? Here we're showing you a little bit more. We're showing you that, again, it's 10 cents per pip. This is the margin requirement. So you only need, say, 15 or so dollars here, $12 maybe, or $10 here to enter into this trade of a $1,000 lot, so that it's easier for you to handle with this small $300 account. Are you starting to get the picture? With a $10,000 lot, it gets a little bigger. You need more margin. Now you need $12 or $150 in margin. But your pip to loss, your profit to loss pip ranges, they increase. It's now $1 per pip. Here with a $100,000 lot size, it's going to cost you $1,500 and something to trade that pound in your margin, or $10 for every pip that moved, as you can see here by this chart, with a large $100,000 trade size.